All right, everybody, we'll get started here. I want to respect your time. So it's 7:30 where I am in the Midwest. So at the end of this presentation, I'll open up for questions. So if you have any questions, shoot them in the chat and I'll get to them at the end, or wait until the end and I will take questions there. But no questions during, just so we can have the video run through the recording in Wealth Squad University. And this will be posted probably in the next day or two in Wealth Squad University. But anyways, let's get into it. So tonight we're going to cover lump sum versus dollar cost averaging. This is a question that I get asked all the time. I just got a lot of money. I just got a couple $1,000s, whatever it is. Should I lump sum invest this, or should I dollar cost average? So I wanted to take the time tonight to cover this topic and this kind of push and pull. Do I lump sum? Do I dollar cost average? Or do I do a mixture of both? And my thoughts on it. My name is Colin, but you probably see me on social media or in the Wealth Squad as DecadeInvestor. That's where I hang out on Twitter, Instagram, and YouTube. A little bit about me real quick. Like I said, my name is Colin. I'm 23 years old. I live in the Midwest. And my investment allocation currently is around 80% index funds, ETFs, 18% individual stocks, and then I have a little bit in crypto. And I don't do any options or anything like that. I'm 100% a buy and hold investor. And so that's just the rundown of me. So let's get into this topic of lump sum versus dollar cost averaging. So I want to cover this. The bulk of this presentation is going to be about this study that was done by Vanguard. This study that helped kind of explain and show the differences of lump sum versus dollar cost averaging, which one's better. Run historical numbers way back to the 1920s, looking at data to see, would lump sum investing or dollar cost averaging be the best for investors. So in 2012, this study was completed. So it's going to be, outdated in the sense of 10 years ago is when they ran the last numbers. But I'll give my opinions on what would have won in the last 10 years, since that 2012 study. But they looked at three different markets. So they looked at the United States, the UK, and the Australia markets. So it wasn't like we were just looking directly at the United States markets. It was, these big three markets that they looked at. And what they did was they examined rolling 10-year periods from 1926 to 2011. And that was over 1,000 10-year rolling periods. So they didn't just look at, it as a whole. They broke it down in 10-year periods, over 1,000 of these, to really analyze the data to see, would lump sum investing or dollar cost averaging be the best for investors? And this is what they found. So they completed that study, they ran the numbers, and this is what they found. Lump sum investing beat dollar cost averaging of roughly 2/3 of the time. Lump sum investing beat dollar cost averaging about 2/3 of the time. And the powerful thing is like I said, there was those three markets, the United States, the UK, and Australia. Those results stayed true across all of those. So it wasn't like, in the US markets, it was lump sum. And then in the UK, it was lump sum. And then Australia, it was dollar cost averaging. No, lump sum beat dollar cost averaging about 2/3 of the time. And it stayed true across all three of those markets. Now, we could stop here and just go, I'm going all lump sum investing. But there's kind of more to the story, and there's more to the data that they found. Because you could stop here and just go with lump sum investing, but there is more to the story that I think is important to understand, and really can help shape your decision if you ever have the opportunity to lump sum invest, to help you decide which one you wanted to go with. So when it came to market downturns, so in down markets, the study found that on average, lump sum investing declined 22.4% of the time, while dollar cost averaging declined 17.6% of the time. So when it comes to market downturns, dollar cost averaging doesn't have that increase of downturns or declines compared to lump sum investing. It's about a 5% difference, give or take a few basis points. But on these market downturns, when you lump sum invest, you're going to see your money decline at a greater rate or a greater amount of time compared to dollar cost averaging. Because if you think about it, if you buy, lump sum investing, you buy all your money, you invest all your money into, a stock that's $100 per share, and then it falls to 90, well, then you just lost $10 per share. And you have no, in the sense of this, you have no more money to invest. So your cost basis is still at $100. But if you dollar cost average, you buy at 100, you buy at 98, you buy at 96, you buy at 90, your money is going to decline at a slower rate or less amount because of that dollar cost average. You're buying the road down, or the stock price down. So if your goal in the stock market is dollar preservation, dollar cost average is your safest bet, because that dollar or that money is going to be preserved better in dollar cost averaging, because you're going to buy that dip down, you're going to buy that road down, as compared to lump sum investing. You're bought in for a cost basis at 100. It doesn't matter if it goes to 90 or 110, your cost basis is going to be at 100. Now I know, when you do lump sum investing, you're probably going to invest that money, and then hopefully you're investing every single month. But when you think of lump sum investing, imagine someone investing $1,000, or they have $1,000 to invest, and they invest it all in that one time, versus investing that, $100 every month for 10 months, right? So you take all your money and you put it in at one time, versus averaging it out $100 a month for the next 10 months. It's the same amount of money invested, but it's different, because with dollar cost averaging, you're buying the ups and the downs, while lump sum investing, you bought in for that one cost basis, that one average cost, and that's what you have. So if your goal is dollar preservation, dollar cost averaging will be your safest bet. Now, obviously, it's all of our goals. We don't want to put money into the market and not preserve our money, right? Your goal is not to, invest in things that are going to go bankrupt. But what I mean by that is, if you're, nearing where you need that money, dollar cost averaging is going to be your safest bet, because you'll see less decline in the sense of your returns or your money, because you're dollar cost averaging rather than lump sum investing. So this is a kind of interesting information from that study, because like I said, about 2/3 of the time, lump sum investing beats dollar cost averaging. But the difference in gains was only 2.3%. Now, I know that does equate to a lot of money. We can see down the next bullet point, but it's only 2.3%. So it's not like it was, 10% better or 30% better. It was only 2.3% difference in gains, lump sum investing versus dollar cost averaging. Now, this kind of equates to a $500 a month investment with 30 years to grow. At 8% return, that's going to be 745,000. At a 10.3% return, that's going to be $1.2 million. Now, this is 100% dollar cost averaging. These are not just lump sum investing, but it was just to show you that 2.3% in this example equates to roughly, $500,000, give or take some money. But that's kind of the interesting piece from this study, was while lump sum investing does beat DCA 2/3 of the time, the difference in gains was only 2.3%. And I'll kind of say, I'll talk in a second why I say it like that, because when you lump sum invest, there is a lot of, you got to have diamond hands, because you're going to see your money go down more than dollar cost averaging. So why would you, after telling you that study and lump sum investing wins 2/3 of the time, and they win in gains by 2.3%, why would you ever choose dollar cost averaging? Well, one, 2/3 is, roughly 66%. So that's not a huge winning rate. I mean, it's still a winning rate, but it's not massive. It's like 80 or 90. But when you lump sum invest, like I was saying earlier, you're buying in for that one average cost, right? $100. And if you see your money or you see those shares fall to $90 and you lost $10 per share, that could really cause fear, especially to new investors if they don't understand how the market works, is because they see that money, that portfolio, go from $1,000 to now $900. They lost $100 in the market, rather than if they're dollar cost averaging, it averages out over time. Like the second bullet point says is, you can average if the market's going down. When you dollar cost average, you're averaging down in your positions, which makes the losses not as bad because you're buying at 100, you bought at 98, you bought at 97, you bought at 86, whatever it fell to. You're averaging down, while lump sum investing, your cost basis is going to be what you bought it at. However, in an up market, in a bull market, the lump sum will be the winner, because if the stock prices just continually rise, then and you bought in, you're gonna, towards the bottom of that bull market, then you'll be sitting, pretty well compared to someone who dollar cost average when the shares were only going up. The price of the shares were only going up because they're dollar cost averaging up, which is increasing their average cost, while you lump summed at 100, and now it's, went its way up. So you got in at a good price. So what I was saying earlier, how the Vanguard study ended in 2000, or they ran it in 2012. Well, since 2012, if you take away last, 2020, we were in a bull market. So someone who bought in 2012 at a lump sum is going to have better returns than someone who DCA'd the last 10 years, just because the market over time has gone up. And, again, this is investing in companies or funds that are going up, not, investing into companies that are going down. But so in an up market, in a bull market, lump sum investing is going to win always, just because of the nature of the share prices increasing over time. The kicker here, and this is just with anything, doesn't matter if it's lump sum investing, dollar cost averaging, or just investing in general, no one knows, that's a typo, what the market is going to do. No one knows what the market's going to do, right? So we could say it's going up, so I'm going to lump sum. Well, then it could go down, in the next year, it could be on a downtrend. Or I think it's going down, so I'm a dollar cost average. Well, then this was an uptrend or a bull year, and now it's going up, so I should have lump sum, right? So we'll never know what the market's going to do. No one knows. No one can predict the future of the market, in the short term. In the long term, you can say safe bet what you think it'll do, but in the short term, it's nearly impossible to know what the market's going to do. So what could you do, right? What could you do if you have a lump sum to invest, if you have money to invest? What could you do? You really have, three options, three possible outcomes. Number one is you could lump sum, right? You say, I got $1,000, I got $5,000, I got $50,000, whatever it is. You could lump sum and say, I'm just going to buy it tomorrow, put all 5,000 or put all that money in the market at one time, call it a day. And I'm going to play the 2/3 odd of the study, and I'm going to run with it. The second thing you could do is, I'm going to skip to the third one, is you could dollar cost average all of it. So let's say you have $50,000. Well, I'm going to put $10,000 a month in the market for the next 5 months. Or if I have 5,000, I'm going to put 1,000 in the market every month for the next 5 months. You could do that. The third way is a mix of both, which is to lump sum a percent of that money and then dollar cost average the rest. So you're kind of getting a little mix of both. So if, let's say, for example, you have $50,000, let's just say you have $10,000 that you just got, right? So you can lump sum 10,000. So I'm going to put 5,000 in the market today, or, at this time. And then for the next 5 months, I'm going to put 1,000 in the market. So I'm going to dollar cost my average with the rest, dollar cost average the rest. So it's a little bit a mix of both. Someone who is okay seeing their portfolio go up and down, have, see those red days worse than if they dollar cost average, but they're bullish in the market, then your lump sum all at once would be a great opportunity. Someone who is maybe a newer investor or can't stomach seeing their portfolio down a lot, and they want to be able to buy the dips, or they want to be able to feel more comfortable investing, then dollar cost averaging all of it would be a great opportunity. Or someone who, maybe a little bit of both, they're not, they don't know what the market's going to do, they're unsure, or they're okay seeing those dips in their portfolio, but they want to have some money ready that's equivalent to what they kind of put in the lump sum, then they could do a mix of both and lump sum a percent while dollar cost averaging the rest. So there's really no right answer. I mean, if you want to just do it based off of studies, then your right answer, would be to lump sum. However, again, we don't know what the market is going to do in the future. No one knows. So historically, lump sum investing is one or beat, dollar cost averaging 2/3 of the time. That doesn't mean in the future that it will beat it 2/3 of the time. It just depends on what the market does. And there's a lot of factors that play into it. So that's kind of the deciding factor. The hardest reason why there's no true answer with really anything in the market is because we just don't know what the future of the market is going to do, which makes us have to be right or have to take a decision or take a side on what we're going to do. So here, like I said, you can either lump sum all at once, lump sum a percent, and dollar cost average the rest, or dollar cost average all of it, and run that way. So there's a lot of different options you can do with lump sum investing or dollar cost averaging. I wish I could give you an answer, but what you can do is use the information from that Vanguard study, and kind of make a decision for yourself. If you ever come in an opportunity of being able to lump sum, what do you want to do? And then once you make that decision, roll with it. The biggest thing with the dollar cost average route is the best way to get the returns that you want to see with dollar cost averaging, or the best way to do it is to equally dollar cost average every single month or week, whatever it is. So if you have $5,000 to lump sum, but you choose the dollar cost average, you do $1,000 a month for 5 months, or $2,500 a month this month, the next month, whatever it is. Keep it the same throughout so you can get the best results of that dollar cost average. Because you could think next month, oh, there's a dip, so I'm going to put more money in than I did last month, but then in the next month it dips even more, so then it kind of runs backwards. So the best thing you can do with dollar cost averaging, if you have a lump sum of money and you decide to go the dollar cost average route, is to figure out what the amount of money you have, and then even it out however far in the future that you want it to be. Now, the other thing about the flip side of that is that common saying, time in the market is timing the market. I completely said that wrong. Time in the market is better than timing the market. And so, time in the market is lump sum. I put my money in this month. If I dollar cost average over 5 months, well, that's 5 months that my money's not in there working for me, whether it's going up and down. So that's kind of the other pull of lump sum, is that time in the market beats timing the market. So there's a lot of factors that play into it. And again, I wish I could give you an answer of which one's better. Studies show, or history says, that lump sum investing wins 2/3 of the time, but that's historically, not in the future. So that's kind of those options you could do with lump sum investing or dollar cost averaging. So I'm going to open it up for questions. If you're hopping off, thank you so much for being here. My Twitter, Instagram, and YouTube is DecadeInvestor. So anytime you have any questions, you can either send me a question in the Well Squad, or on Twitter or Instagram or YouTube at DecadeInvestor. But I'm going to open up for questions. If you have any questions, raise your hand in the chat. That way, no one, that's the best way to do it. So we don't have like 4 people shouting at the same time. Or drop your question in the chat and I'll answer it as well. So thank you again if you are hopping off. Thank you for being in the Well Squad. And if you're staying around, then I'll take some questions here for as long as it takes. So let me get off of this, and then I'll open up for questions. So thank you all again.